So today we're looking at bonds. So if you have a Fidelity trading account, you can go ahead and buy bonds through their platform. So let's get straight to it. We're going to go over to the news and research tab, and then we're going to click on fixed income bonds and CDs. And now we're going to be taken to the page where you can go ahead and select the different types of bonds. So if you scroll down, you'll see CDs. This is certificate of deposits. Basically, it's just a security where you promise to put your money away for 3 months, 6 months, 9 months, and then they'll give you a rate of return in exchange. These are relatively, probably one of the most safest securities when it comes to fixed income. If you scroll down, you see U.S. Treasury bonds. Then you have U.S. Treasury zeros. Zeros are basically, these are the type of bonds that don't pay any interest per year, but they still offer a rate of return. So when the bond matures in 3 months, like for example, this one says 3 months, you'll earn 2.25% on the zero U.S. Treasury bonds. All right, next up we have the agency bonds, and then after that we have the corporate AAA bonds. These are basically bonds that big companies will, when they need money and they want to borrow, they'll basically issue these corporate AAA bonds, and in exchange they'll give you a rate of return on top of interest. Well, the rate of return is the interest that is offered. Then you have the corporate AAA bond, which is basically the same thing, but these are rated by the credit rating agencies, and typically the AAA is among the safest. And then as we get to the AA, single A, and triple B, which are the most riskiest amongst all of these, then the credit rating agencies will go ahead and issue these bonds or rate these bonds. But yes, corporate B bonds are the riskiest, but they do offer the higher rate of returns. Okay, then you have the municipal bonds, and these are basically bonds that are issued by the state. So, for example, if you live in California, you can probably find a municipal bond from California, and they pretty much work the same way that a U.S. Treasury bond. However, these are not backed up by the U.S. Treasury. So, for example, if you were to buy a U.S. Treasury and the American government goes downhill, the Fed or the Treasury will actually print you your money back, and it is guaranteed. Versus the municipal bonds, that's not the case. Then you have taxable municipals, which are basically muni bonds that are taxed. Yeah, so the next thing you want to look at is the maturity dates. These are the maturity dates. So you want to take into consideration how long you want to lock your money up in these bonds. So if you don't need the money for a while, you can look at a 3-year bond, 5-year bond, 10-year bond, and they even have 30-year bonds. Keep in mind though that you want to make sure the longer that you commit to these bonds, the more sensitive they're going to be to the current interest rate changes. So for example, right now in California, I don't remember exactly where we are, but interest rates could be 3 to 4% right now. And so if you were to buy a 30-year bond at a 3%, and then interest rates go up 5%, you just lost, well, you didn't lose, but your bond is valued a lot less. And, over time, you could lose a lot of money. So you want to make sure that, if you're getting a long-term bond, it's at a competitive rate. Historically, this is just my opinion. This is not a fact, but, we might not ever see interest rates go higher than 5 or 6%. So these 30-year bonds, they're not that attractive, but they do offer a decent return, compare and are also really helpful when you want to balance out your portfolio to help minimize the risk. So that's up to you to analyze. And then so let's say we want to actually purchase one of these bonds. Let's say we want to do a 10-year bond, and I want to do a U.S. Treasury bond, and the current yield is 2.87%. So let's click on that yield. Now I'm taken to this separate page here, and I have a list of different bonds that I can purchase. So for example, this one is the United States Treasury bond, and it says 5.25%, and that's the coupon rate. So when the coupon rate is higher than the yield, so for example, the current yield is 2.8, this bond has a higher coupon rate. So if you look at the price here, this price is $120. That means I'm going to get 5.25% of $120 each year as interest. So because the coupon rate is higher than the yield, this bond is selling at $120, and that's considered a premium. So in other words, we're paying more for this bond because the coupon is paying higher than the current yield. And for example, if we look at this bond here, which is the U.S. Treasury notes, and the coupon rate for this one is 2.875, and the yield is 2.862. So it's still a little bit higher than the current yield, but it's a little closer to the yield. And if you look at the price is actually $100. So you could pretty much argue that this bond is selling at what's called the face value, because the coupon is really close to the yield. But versus this bond is paying a higher coupon than the actual yield, so they're going to charge you $20 extra to buy this bond, simply because you're getting a better rate on your coupons. Now, the one thing I don't like about Fidelity's, or I shouldn't say Fidelity, I should say one thing I don't like about buying bonds from Fidelity is that you need to have a minimum amount to buy. So for example, if I wanted to buy this bond, I would have to purchase at least 200 bonds of this security in order to buy this bond. And I don't have that kind of money. Or let's say you don't have that kind of money, then you can't buy these bonds because you need to fulfill the minimum requirement. So, but if you do have the money, then you're just going to go ahead and click buy, and then you can also sell your bonds if you want to get rid of them. And yeah, so that's one way to buy bonds. Let's say you wanted to buy bonds and you don't have this minimum requirement amount. You can actually purchase bonds through what are called ETFs. So if you go back to news and research, we can actually find ETFs that have basically a basket of bonds. And the way you want to do that is click on ETF screener, and we can pretty much scout out different types of ETFs that have bonds. And again, they're going to be in the fixed income category. All right, so basically this kind of gives me a variety of different options. So like, for example, we can do US total bonds, we can do US corporate, global total bond, US governments, global governments, emerging market government bonds, US municipal bonds, mortgage-backed security. So this is more of a fixed income, so this is not a bond. This is basically like you're buying mortgages, and you're getting a return on those mortgages. And then you also have, we haven't talked about US inflation protected, but these are basically what are called TIPS. And these are bonds that basically protect you against inflation. So if inflation goes up, then they will actually pay you an interest rate based off the increase of the inflation. Vice versa, if the inflation goes down, then your interest rate goes down. So let's say we wanted to do a total bond, US total bond. I'm taken to this page here, and I have basically a total bond of all these different types of shares. Let's say I wanted to go into iShares US Fixed Income Balance Risk. I'm going to click on the symbol name. And now I can pretty much look at this ETF. So a couple things when you're looking at ETFs, you just want to make sure the net expense ratio is as low as possible. And usually anything below 1% is pretty good. As you can see here, this is 0.25, so that's pretty good. A couple of other things you want to look at if you want to check when they pay out distributions. Usually for bond ETFs, they're paid out every month, so that's kind of nice. And this ETF will basically show you what it's holding. So if you want to get real in depth on the actual holdings, you want to click on this see more button under the top holdings, and it'll take you to a page where you can see what this fund is holding. So for example, 80% of it is held in the or North America. 86% is the U.S. Top 10 holdings, you have some mortgage association. Let's see what else it has. It looks like it's actually holding 85% corporate bonds. So this might not be a good ETF to have. I mean, if you want to do corporate, that's fine. But I'm looking at this ETF and it says 86% corporate bonds and 37% mortgages. So I may not want to buy this ETF. So what I can do if I don't want to buy it, I can pretty much go back and go back to my screener and choose a different fund. So let's say I wanted to go U.S. government. Oh, here we go. So here we have U.S. iShares. We have short treasury bonds. We have 1 to 3 year treasury bonds. And we also have 7 to 10 year treasury bonds. So I know that I'm going to get the higher rate of return in the 7 to 10 year treasury bonds. So let's say I want to click this one. And this green symbol basically tells me I can buy this ETF and pay no commission fee for the transaction. And I can actually compare too. So what I'm going to do is I'm going to close these windows out, and I'm going to open up another window that compares the 7 to 10 year bond compared to the 20-year-old bond, which is with the TLT. So I'll open up TLT as well. Here we're looking at the 7 to 10 year bond. If we can check on the dividend return, we're going to get 2.2%. And let's double check our holdings. And as you can see here, we have 99% government bonds, all which are 7 to 10 year securities, which is good. Let's double check the TLT. So now the TLT is paying a 2.7 versus the 7 to 10 year is paying a 2.2. So these are 20-year-old bonds. So I might want to look at something like the TLT, where I'm going to get a higher rate of return on my money. And the good thing about these ETFs is that you don't have to hold them for 20 years. Unlike the bonds, the original bonds, you would have to hold those for 20 years to see the maximum rate of return. But with the ETFs, you can pretty much just buy and sell these whenever you want. You don't have to hold them for 20 years. And this this chart basically shows you the price of the ETF. And as you can see here on, let's say 2007, the bond opened at $84, and you fast forward to now, it's at $114. So it has gone up in value. But let's take a look at some of the returns. What are the returns that we're going to get on this type of fund? And let's see here. So we have NAV, that basically stands for net asset value. And if we want to basically compare the type of returns. So if we look at this section here, this is a benchmark index saying that the US Treasury plus this specific ETF, since the initial inception of the ETF, has yielded 6.2%, which is pretty good, considering that it is a bond ETF. So you might be better off just buying a bond ETF versus buying a regular bond, because if you know you're buying a 20-year bond and interest rates go up, you're losing value on your bond. Now that is vice versa. If let's say you bought a bond for 4% and interest rates go down to 3%, then your bond goes up in value. But with an ETF, these are almost traded like stocks. And so you can pretty much buy and sell whenever you want. And I think, and this is just my opinion, because of the liquidity, the higher liquidity, basically, it creates a higher demand for people to buy these ETFs, because they know that they can just buy these funds and pretty much sell and buy whenever they want. So anyways, I hope this video was helpful and informative. If you have any questions, please feel free to leave me a comment down below, and subscribe to my YouTube channel for more videos on investment tutorials. Thanks for watching.